It's one piece, folks. One video and one video only for me to react to in this one. On Fast Money, Steve Eisman just went on, gave his opinions about the stocks people shouldn't be investing in right now, the stocks they should be investing in, shouldn't be investing in, what he expects for the market moving forward. He speaks about, his thought process about recession, about the state of the economy, the state of the market in general, some tips that he's learned over time in the market. So a bunch of things to get into. I appreciate everybody joining me as always. I just want to jump straight into this, folks. Thank you for being subscribed. 35,000 plus subscribers now here on the Reaction channel. And by the way, if you ever want to say hello to me on IG, my Instagram. That is the pinned comment down there. I'm always posting a ton of stories and stuff on Instagram, so make sure you give a follow on there.
The market lower when we actually go down 20%.
100%. It's good news that the equal weight is catching up, although it be a very small data point.
Let's get to our guest now. He is known for predicting the 2008 housing market crash, and now Big Short investor Steve Eisman is homing in on the banks. The group kicks off earnings season this Friday. Steve joins us now. He's a senior portfolio manager at Neuberger Berman. Steve, always great to see you.
Thanks for having me.
You've said before, not too long ago, like 2 weeks ago, banks are completely uninvestable. I think you came on our show, too, the last time and said the same thing. Do you still see that? And what are you looking specifically for in earnings at this point? What makes them uninvestable at this point?
Well, let's start with the conclusion. They're still uninvestable.
Okay.
We could go to the next topic if you like, but if we'll stick with this topic, the problems are net interest margins are still under pressure. There are about $2 trillion in excess deposits in the system that are going to continue to gradually lead. So estimates are still probably too high. You've got the regulators fighting, as I like to say, the generals fighting the last war. They're increasing the capital requirements of the banks when really what they need to do is just improve the liquidity of the mid-cap and small-cap banks. And so that'll hurt returns next year. And I mean, I have no prediction about there being a recession at all. As of now, there's no data, but let's assume there is one. You haven't had a credit cycle yet. So the only reason to invest in banks is that they're cheap, but there's one thing I've learned in my career, and I've only had to learn this the hard way multiple times, is investing in something just because it's cheap is a value trap, and shorting something just because it's expensive is a death wish.
Okay, so hold your horses for just a moment. Hold your flip and flapjack and horses, because I gotta say, he's pretty much right on in regards to that. Very, very accurate. Not all the time is it perfect like that, but most of the time, if you're shorting a stock especially, you should not short based upon valuation. It has to be other things, like a deterioration in the business model you see coming. Maybe they got balance sheet problems. They won't be able to raise any sort of debt, equity problems, something like that. Okay, it's got to be something past just like it has a high PE. Okay. Secondly, buying a stock just because it's cheap, usually not a very good, let's call it thing, because there's always going to be a lot of stocks that are cheap in the market, right? It goes a little further than just this stock trades at this PE, so therefore I need to buy it. You have to have belief in the business model strengthening over time, the net income strengthening, and it being cheap. Then you found a good opportunity, right? We'll see if PayPal is that opportunity, but certainly when I look at PayPal stock, it fits the criteria of, I believe it's going to have nice revenue growth over the coming years. Earnings per share growth is going to be faster than revenue growth, and it trades incredibly cheap. It's at like 11 times this year's expected numbers, right? So you can look out there, but it's got to have those business fundamentals. If it's just like it's cheap to cheap, it can get a lot cheaper, folks. Look at Ford and GM stock. There's many times those stocks have traded at 4 Ps, 5 Ps, 6 Ps, but they're trying to transition their business models to completely different business models than what they've been over the past, let's call 50 years, right? Which is a very difficult thing to do.
I'll be on the calls, and then thankfully the weekend will start, so people won't be all that depressed about it.
You're also not optimistic, if I can put it that way, about the consumer. Is that
Oh, that's not fair. That's not true at all.
Oh, it's not? Okay.
You've got wrong information.
Okay. You like the consumer where they stand?
It's not that I like the consumer. I mean, in terms of the overall health of the economy, the consumer is fine. The consumer has savings, the consumer is employed, the consumer has income. So it's not a...
Wow, so that's a big, difference between Steve Eisman, the man that's famous for The Big Short, and a lot of people, because a lot of people just keep beating up on the consumer, and the consumer is this, and the consumer is that, and they're done, and they're finished, and they're this and that, right? He thinks the consumer's fine. He doesn't say necessarily they're in a great place, but he says the consumer's just fine. So very differentiated view by Mr. Eisman here than you might have heard prior to the great financial crisis, right? And so who's right? him or these other folks that keep talking about the consumer?
Point in terms of there being a recession. Where I think you could be negative is just that, rates are a lot higher. It's more expensive to buy a house. It's more expensive to buy a car. It's more expensive when people finance something. It's more expensive to put a solar panel on your house.
Yep.
So any part of the economy that's involved with the consumer buying something that also requires it to be financed has problems. Mm-hmm. That's not necessarily.
What have I spoken about over the past year? Anything you got to buy on debt is going to have a tougher time business model. Furniture, homes, autos, all those things. I've been talking about that for a year.
An indictment of the consumer. That's just a mathematical fact.
So are you positioned to reflect that? In other words, are you short any of the...
Oh, I don't short for clients anymore.
You don't
but, I wouldn't own home builders right now. I mean, they've had a great run. But the home builders have been subsidizing their customers with lower rates, but even that's going to bite. I wouldn't be involved with building products to any significant degree on the residential side. I don't think you should buy somebody who finances new cars or used cars, et cetera. Anything in that universe, I think, is just going to have trouble just because of simple math. I mean, I did this calculation.
Lending, right?
When mortgage rates were 7%, now they're 8%. But when they were 7%, for you to buy somebody out of a house where they have a 3% mortgage, for you to have the same monthly payment, the house price had to be down 40%. So now it's 50%.
Wow.
That's just math. Mm-hmm. Now,
that's freaking sane. The house price has to be 50% lower today to get the same mortgage payment that you would have had previously when, rates were 3%. What? That's insane.
No.
Like, literally, that's mind-blowing. Literally mind-blowing. That's why there's such a difference between a 3% mortgage and an 8% mortgage, right? My gosh.
Going to sell their house down at all if they have a job. They just won't move. Yep. So the housing market is locked.
Yep. Stalemate.
People can't buy and they can't sell. Now, the housing market is not nearly as important a part of the economy as it was in 2008. It doesn't help the economy, but I'm surprised as everybody else that the economy is as strong as it is. You have to respect it.
So you're talking about the consumer. You think the consumer's in okay shape, but isn't able to do the things that they've been doing in the last couple of years: buy cars, buy
less
houses.
of it.
Right, less of it. So ultimately, how do you think that stalemate resolves? Do they continue to not buy those things?
I think they continue to not buy those things.
And rebuild their sort of savings and then ultimately spend again, or just...
Yeah, I think that's probably what happens. I mean, like I said, you would have thought, given what's gone on with rates at this point, that the economy would be in a recession. And not only are we not in a recession, we're not even close to a recession. So, look, I'm not an economist. I think everybody should have a little humility at this point about predicting recessions. I watch your show. I watch other people's shows. I read other people. So there were people who were negative going into the year that became positive. There were people who became positive were negative. They've all been wrong. So everybody should just take a step back, take a breath, and just say the data currently says there's no recession, and we'll see what happens.
100%. That's a freaking phenomenal point he brings up there. And you look at it in, if you look at almost every macroeconomist, going into this year, they're all predicting recession this year, right? They're all predicting problems, and we just haven't gotten that. And so every macroeconomist has been wrong. And that's all these folks, these are supposed to be professionals. This is all they focus on, right?
So, Steve, you mentioned that the banks are uninvestable. You've said that routinely now for the last few months. They've acted horribly as a group. We would all agree that they're not all created equal. There was an article yesterday in Bloomberg that really caught my eye and a lot of other people.
Let me guess. Bank of America.
You got it. B of A's wrong way rate blunder.
By the way, in my world, that's old news.
Right. No, well, that's the thing. We've been talking, you watch our show, we've been talking about the relative underperformance. Karen has a bank that she likes an awful lot. And this one acts
Which one is that?
JP Morgan.
Okay.
Yeah.
So
you don't watch that much, though.
Yeah. No, but it was.
No, I mean, I have a joke where I say if I was still a sell-side analyst covering just banks, I literally would write the same thing every single day. Banks are uninvestable, but if you have to buy a bank, buy JP Morgan, call me in a year.
Yeah.
There's one bank stock I own. One bank stock. Guess what it is? JP Morgan. Okay, one bank stock. If you force me to buy another bank-related stock after that, I don't know, I might consider Ally or Goldman Sachs. But yeah, there's one I own, JP Morgan, and that's it.
Back to your, discussion about value traps and, death wishes to the short side. I mean, when you think about Bank of America, can they work their way out of this blunder? Does it become investable at some point? It's getting really cheap. And if you think about what they did, if they can hold on, if they don't have a draw on deposits.
Oh, they will. Let's not get people crazy.
Yeah.
This is not Silicon Valley. The reason why Silicon Valley happened is because they had a much bigger problem in terms of the math than Bank of America. And their depositors were all venture capitalists, pulled their money, so they had to sell their bonds. Bank of America, I don't lose any sleep worrying about Bank of America, believe me. Would I buy Bank of America today? I wouldn't, because it has an earnings problem. It's an earnings problem. It's not a capital problem. It's not a solvency problem.
Interesting.
It's a question of what do you want to pay for a bank that has net interest margins problems, and it's going to have them for quite a while. I mean, when you have a $700 billion portfolio that's underwater, it's a problem.
That should make everybody feel a little more comfortable about systemic risk, the banking system in general. Because, I mean, I don't want to say Steve Eisman's a banking industry expert, but Dan, for him to make the bets he made prior to the great financial crisis, you better know what you're freaking doing. You better know bank balance sheets inside and out and exactly what's going on with these guys. And so for a man like that to say, I wouldn't buy the stocks, but at the same time, there's no real big problems there that he sees, that's huge. That's huge. That takes a massive risk out of the market. Because let's not forget, one of the big reasons we had the great financial crisis in that devastation where the indexes fell 50%, right, was, at the end of the day, the banking system collapsing and the dominoes falling one after another after another. And he's basically telling you, when it comes to the big dogs, not much to look at there. The smaller ones might be a little bit different situation.
Not a disaster.
Small business hires, I think, almost 65-70% of the people in this country. Basically the lifeblood of small business are small and regional banks. If credit conditions tighten, regulation, a myriad of different things, how important is that whole set of circumstances to the economy?
Well, they're already tightening because they're losing deposits. I had a small thesis earlier in the year that when Silicon Valley happened, this would really slow the economy. It hasn't. I'm not exactly sure why. But there's a lot of fiscal stimulus. It seems like people who are in business can still get loans. So yeah, on the margin, it's restricted, but it doesn't, at least at this point, doesn't seem to be having an impact. And I'll be the first one to say I'm surprised by that.
Steve, you had mentioned before that, shorting stocks just because they're expensive is a death wish. And I'm wondering, your comments about recession, I think, are really spot on because there have been so many people who have been dogmatic in their view that a recession was going to happen this year. And that has caused them to move higher in equities.
Right.
So, I mean, is there sort of a parallel, trying to call a recession, trying to basically short the economy is also like a death wish?
It's not a death wish. In our business, being early or too early is the equivalent of being wrong. The question is, how early? So if you're a year too early, you're wrong. If you're 6 months too early, you're wrong. If you're a month.
That's exactly like the movie, you guys, I'm sure you've seen the movie The Big Short before, right? He was early, to be quite frank. He was actually, I think, like 2 years early in calling the housing bust, if not 3 years early, in calling the housing bust and the great financial crisis and those sorts of things. And he had an answer to his investors at that time because he was investing other people's money. And they were, he's basically like, no, I'm just a little early on this. And the guy goes, it's the same thing. You're wrong, and whatnot. So, anyways, interesting. And so that's funny. He brings up that point. It must be a reason they brought up that point in the movie.
Early, you're a genius. So, in our business, being early or too early is the equivalent of being wrong. The question is, how early? So if you're a year too early, you're wrong. If you're 6 months too early, you're wrong. If you're a month too early, you're a genius. So it's a question of timing. What I would say to anybody who's trying to predict a recession is, okay, I get your thesis, but now why don't we just wait for a data point that indicates that it's happening before anybody starts to make such a major call about it?
So last time we heard you were pretty positive on infrastructure.
I still am.
Do you think, I want to know if you still are, do you think the move in rates has dampened the infrastructure demand? Do you think it'll happen anyway?
I think it happens anyway. I mean, it's $1.2 trillion that the United States government's going to spend. It's not going to really matter what interest rates are. So that doesn't mean that there aren't parts of the infrastructure or greenification story that aren't impacted, like residential solar is definitely impacted because, yes, you could get a tax break. But if you're going to be paying triple monthly what you were going to pay 2 years ago, you may not put a solar panel on your house. So, solar was considered a growth industry, and now volumes are negative, which I think has shocked the hell out of everybody who invests in residential solar. I think there'll be a time where that'll come back.
I got a lot of questions about Enphase over the last couple of years, really, and Enphase really hasn't interested me. Not because it's a bad company. I think it's a pretty dang impressive company, and obviously what they've built there. But at the end of the day, when it comes to Enphase, I knew interest rates were going to hurt this company substantially, right? And I mean, you pull up a 1 year on this baby, it's down 51%. Yeah, I mean, at the end of the day, Enphase, it was an incredible stock, but when you talk about these interest rates, if it wasn't for these interest rates, I think Enphase is maybe at an all-time high right now or something like that. But with these interest rates, with how much the Fed's raised, it's going to hit solar, it's going to hit housing, it's going to hit all that stuff.
Not uninvestable, it's investable. It's just a question of when. I think it's a little early right now.
So Steve, we talked about at the top of the show, wages are actually sticky. Wages have gone up. So can we make the connection that consumer stocks that you don't need to finance for are probably going to be stronger going forward? Sort of counterintuitive.
I understand. It could mean reallocation of money.
Exactly.
Possible.
Yeah.
That's definitely about me. Look, when you buy stuff on Amazon, you generally don't finance it. Right. You finance it on your credit card. And that's fine because you tend to pay it off pretty quickly. But anything that has any financing duration is a problem.
Yep.
How are you feeling about the big cap tech stocks, the so-called Magnificent Seven? Are you long any of them?
Like everybody else, I am.
Okay.
I don't know if I have any more insight into them than anybody else, and I'd probably be humble enough to say I don't have any more insight into them than anybody else. But clearly,
you have to.
It's not that I don't own them because I have to. I own them because I want to.
If your benchmark,
it isn't so much the benchmark. It's where all the dynamism is going to be in the economy for a long time. Neuberger, we had the CEO of NVIDIA in last week. I don't think I've ever seen a CEO so, let me put it in the right terms, calmly confident in my entire life. I've never seen anyone so completely relaxed and so confident about their prospects in my entire career.
Convincing then.
Yeah.
Okay. Steve, we hope you'll come back soon.
Thank you.
Before we let Steve go,
yes?
You mentioned genius. I don't know who your stylist is, but he or she is a genius because that jacket with the brown, fantastic.
Nice.
You can
Especially
thank my wife. She forced me to buy it.
Well, thank her then.
Thank you, Valerie.
Well
Thank
done.
you, Valerie. You're a lucky man.
Fantastic.
Steve, thank you.
Thank you.
Valerie, thank you as well for the good pick. What do you think?
Well, it's interesting. We haven't even mentioned enterprise spending. Okay, so if Paul Tudor Jones is correct, and at some point early next year we are in a recession, that's the next shoe to drop. And when you talk about this so-called, I like how you do that, Magnificent Seven, they're going to be the ones that actually lead to the downside because they've done all the cuts, right? They've made their business really efficient. They refinance their debt. They're getting paid 5% on all that cash.
They don't have debt.
Well, on a net basis, but understand, they refinance debt. You know what I mean?
My biggest takeaway was the guy with the Big Short claim to fame told you you're probably too negative.
Yeah. Well, but I guess my point is that
that is funny because this man is always so freaking negative, always so negative, and especially over this past year and a half or so, very, very negative.
I think they lead to the downside because markets and investors are going to sniff it out. We haven't talked about a decrease in enterprise spending, and that will be one of the things that gets hit when it becomes very clear that we are seeing weakening economic data.
Well,
I don't know about that. I mean, at the end of the day, you heard what Amazon said about AWS over the past year. Clients have pulled back significantly and really watching spend. So, I don't know.
Just want to say, if it's a balance sheet thing, that is where you want to hide. But
I'm saying that's why the money's going there right now, because I think a lot of folks feel that when it was a drag on these companies.
Basically, he's just admitting that he misspoke there.
Because they had $100 billion in cash earning nothing, right, in treasuries, right, that Brian Moynihan was buying lots of, okay? These folks were refinancing, and then they're still earning billions of dollars a quarter, you know what I mean? And now they're earning an interest on that.
I agree with you on one thing, though, if I could just add, that the math of the buybacks no longer works. When the cash makes 5 and the earnings are north of 20, it doesn't work the same way.
Yeah.
Good point.
Math. No, it's interesting. You hear Steve, he's very pragmatic, but then you listen to Paul Jones on the network today. I mean, some of the comments. Then you listen to Marco on our show a couple weeks ago. There are people that are extraordinarily bullish. And
Marko Kolanovic believes SP going down, I think it was 20%, if I recall. We'll see. We'll see. This is what makes a market, man. This is what makes a market. You got the people super bearish, super bullish, in between.
People on the flip side of that coin. I don't think, we've been doing the show a long time. I mean, people are dug in on both sides, and you can make a cogent argument for both sides at this point.
I also heard from Steve Eisman that he likes NVIDIA. He didn't say it.
Yeah.
That's what I heard.
Up 213% year to date. And everyone talks about pixie dust. I always say dust, pixie dust, but these are the companies that are actually monetizing AI. Everything else is sort of a wish scheme, but they're actually making, I think this year, $20 billion on AI.
You guys, every day there's a news story about one of their customers, okay, who's buying those H100 chips, who are actually developing competing chips, their own chips. I'm just saying, for now, but hold on, Mel, I want to say one other thing, okay? So Jensen Huang...
damn it, I'm going to cut you off, dude, okay? This is such a misunderstood, you don't understand what's going on, dude, okay? Guys like this thing, Dan Nathan and these other folks, they think, you could just copy NVIDIA's chips, you can just do your own, and I hear about these other guys. It doesn't work like that, dude. It doesn't freaking work like that. You can't just be like, we're going to create the NVIDIA chip, okay? And it takes you several years to develop what they got today. NVIDIA keeps moving forward. I don't even own NVIDIA stock. I'm just explaining to you how this stuff works. NVIDIA keeps moving forward. Then you're trying to chase the chip that's like 3 years in the future that they've already been working on, and you're trying to work on what they already created 3 years ago. So you're always behind. You're always behind. You're always trying to play catch up to the newest technology, and NVIDIA is just beating you to the ball again and again and again and again. So, it's just ridiculous. But I've heard this point talked about again and again by these folks, and they just don't understand how difficult this stuff is, and that you can't just copy what somebody else is doing and expect it to be just as good. It doesn't work like that. And believe me, if it worked like that, freaking every company would be doing that.
I guarantee you, before the metaverse, before a data center, before crypto mining, it was very calmly optimistic. I'm just saying, he's a genius CEO. He's been in front of a lot of these big trends. This one feels like the big one right now, but it has happened before. That stock sold off 75% after the big metaverse push in 2020. I'm just saying.
Right now, they have 85% of the AI market. Yes, it's theirs to lose. You always point that out. It's a great point. Right now, they're the ones that are monetizing it.
There's no commercialized products in the next year for these where companies are meaningfully making earnings.
Except for NVIDIA.
We got to pay some bills, Mel.
Thank you, Guy.
Yes. So, anyways, bottom line is we hear from the software side is going to start making money in 2024. That's what we heard, right? So, yeah, sure. If none of these software guys are making any money from it in 2024, whether it be the AWSs or the Salesforce or the Palantir, or all the way down the Adobes and all the companies that are supposed to make money here, the Microsofts, the Googles, the Metas, if none of them make money from it, sure. Good point. Outside of that, the industry is going to continue to boom, and that will be beneficial to, obviously, NVIDIA, and that will be beneficial to even companies like AMD that are actually playing catch-up. If AMD is playing catch-up to NVIDIA, you think anybody else is going to be able to catch up to NVIDIA? Come on, man. Be realistic about this stuff, okay? They're trying to create chips in the past, so the easy ones to maybe commoditize, you can do that and maybe save yourself some costs. But in terms of the newest tech, good luck catching up to those guys, okay? Appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed to the channel. I appreciate each and every one of you. If you ever want to say hello to me, send me a DM or whatever. Send me it on IG and say hello to me. I appreciate y'all. There'll be pinned comment down there. Much love and have a great day.